My name is Stéphane Vermeer. I'm member of the management board of BNP Paribas Fortis, so I'm a banker. That's also probably the reason why I'm the only guy with a tie in this whole setup. Voilà. And also we probably am an old banker, so that's also the reason why they gave me a cable to make sure that I don't fall on from the podium. I'm heading the corporate banking division, which means that I'm in charge of all the legal entities or the corporate clients, from the small ones to the biggest ones to the multinational, including also the market, financial markets or capital markets activities. I'm going to talk to you about the question of financing. Financing, how can you, if you want to develop a startup, and I'm sure that in this room and probably in this setup, we have many people dreaming of creating their own startup, or if they have already started, they want to bring it to a next level, to the scale-up level, or they want to bring it, and that's the ultimate dream, to the unicorn, or even better, to the listed unicorn level. So let me give you some advice and also some explanation about the different stages and what does it mean in terms of financing. I heard from someone in the room that he gave a presentation this morning, and he said in one of his conclusions as an entrepreneur was cash is king, and cash is indeed king at the different state of developments, but you need to find the right solution to access the amount of cash you need. And it's a bit like a car. A car needs fuel, and today the fuel is more electricity, but a startup needs, of course, a very good idea, very motivated, dedicated people, but you also need a lot of funding, a lot of financing. And the question is, where can you find it? And very often, some people ask themselves, yeah, I'm going to go to a bank with my startups and with my projects. And just to give you an anecdote, last year I was taking part in the Belgium Economic Mission to India, and that's where you meet a lot of people, a lot of entrepreneurs. And one of the questions I received many times was, why do you, not me as bank, specifically, but why in general banks do not want to finance startup in the early stage? And that was a very interesting discussion because I could feel that there was lots of misunderstanding. So before getting into where can you find and what kind of financing do you need, I also would like to address the question of what is the role of bank. The role as bank is mainly to advise you, to bring you to the right experts and so on when you are at the early stage, but it might not be at the early stage to be your funding partner. Why? Because where does the money come in a bank? The money comes from the deposits. The deposits from your mother, from your grandmother, from your grandfather, from your children, from yourself. So we are entrusted with these deposits, and the task is to transform the deposits into loans. Loans to finance individual projects, a house, finance development of companies, small ones, bigger ones. But it comes also with a lot of responsibility, accountability, because your mother, your grandmother wants to see her money back or his money back. So we cannot take excessive risk. So that's something that you need to understand, and people need to understand that even if you are all convinced that your project have 100% chance to be successful, when you look at the statistics, unfortunately, the percentage of success is much lower. And we need to take that into account. So you cannot finance today a project which has a lot of risk with a bank loan, because you have, I would say, an imbalance in terms of the downside of the upside. When you give a loan, the risk on the downside is that you lose everything. If the project goes well, you get your money back and a small interest rate. That's where you have an imbalance. And that's why, at the early stage, equity is much more important than getting bank financing. So that was what I wanted to explain first and to address. I'm going to come back to it. Banks are there to help you, but in the early stage of your developments, do not think that banks do not want to lend you. It's not that, it's just that it's not the best option for you. It's not what banks are supposed to do. So if banks do not lend, as I said, our role is really to advise you, to be there with you, to get you find the right partners, the right investors, to guide you. And be sure of one thing, we believe in your project, we believe in your ideas, we believe in the importance of entrepreneurs, and this country, but also Europe, needs a lot of entrepreneurs, and we will help you. But again, we will help you through finding the right solutions. And I will take you now through the average funding journey of a startup, of a company, startup, scale up, and maybe one day getting the unicorn. I will basically talk about 3 different ways of financing: the equity, the debt, medium to long term, and something that many people sometimes forget, the working capital financing, which is when you have, for example, some assets, you can start working on the working capital financing. But maybe before we get into that, something, and I will not spend too much time on it, but because you may think that it's very obvious, but it's sometimes something that people forget. The first basic rule is to optimize what you already have, to make sure that you don't need extra cash because you optimize what you already have. And that means that, for example, as soon as you have clients, making sure that you collect your payments as quickly as possible, making sure that you try to pay your suppliers as long as possible, and you ask for as much facilities at that level, but also, and typically tools like Odoo and the like can help you, is making sure you have a good planning of your, and a monitoring of your cash flows. That's essential. Again, that may sound obvious, but based on our own experience, this is a rule which is often overlooked. And then if you need IT equipment at the beginning, if you need vehicles, of course, I hope these are electrical vehicles, solution on the medium to short terms are available. Do not think that you have to buy them. Very often, it's much better to rent them. Some people might think, yeah, renting is more expensive, but at the beginning of your life, the question of cost is not the issue. Your question, the real issue is how can I minimize my financing needs and making sure that I need as little funding as possible. So that's a number of key rules, making sure that at the beginning you monitor and you optimize your cash flow, put in place the right financing, rent, don't buy, and if you need to finance fixed assets, don't finance it with working capital. That's something I will come back on it. And again, maybe something which I would like to insist on, the right financing is not by definition the cheapest one. I will repeat it. The right financing is not by definition the cheapest one. The right financing is the one that allows you to grow at the pace you want without losing control of your journey. And again, it doesn't mean that it's the cheapest one. Well, then let's go through different stages. We're going to start with the startup stage. And as a startup, you go through different stages of development, developing your IDs and trying to get a market fit product. And that's where you focus is around, research, making a prototype, conducting a POC, making a first MVP. And the needs for working capital are growing because you start having people on your payroll, you need to pay salaries, you need to pay rent, you need to pay maybe some insurance premium and so on, and your revenues are either zero or at best very limited. So that means at this stage the company doesn't have any revenues, no positive cash flow, no positive EBITDA, and you most likely do not have tangible assets. You don't have that many clients yet, so that means, for example, you don't have lots of account receivable. That's again why, at this stage, it's too early, most likely, to get a bank financing, because what we need is we need to see cash flow, we need to see collateral, and voila. But of course, if you have a very wealthy grandfather who can give his guarantee to the bank, that's another story. So at the first stage, if you don't have such a wealthy grandmother or grandfather, you need to seek external investor, because at this stage, the most important is equity. You need equity because you need to find the right source of financing your startup. And again, rather obvious, it's the families and friends, it's your own pocket. Again, if you are wealthy, you're coming from a wealthy family, it's much easier, but you need to convince families, friends, and so on. But you can also turn to professional investors, and that's where you start having different type of professional investors. You have the family offices, but you can also talk to business angels, and they can not only bring you money, but they can also bring in the experience, the expertise, the networks, and they can really mentor you. And then you also have the seed funds, which are also getting more and more popular. Of course, these are pools of funds which are dedicated to finance, really the research, the first development of your company, and you will find different types of seed funds. either linked to universities, academic research, KU Leuven, that's a very well-known one, or linked to blue chip companies like Intel Capital, or you also have the more public seed funds like PMV in Flanders. Debt and lending is at this stage not that available, as I said, certainly not from banks. At best, you could find some convertible loan. Why is convertible loan potentially available? Because in the case of convertible loans, you have the downside of the loan, but you also have the upside of the conversion. And that's where you get a better balance and a better risk and return. And then at this stage, you also have the option of the crowdfunding. I'm not going to learn you anything about that. Crowdfunding is a very nice opportunity to raise additional funding, but it comes also with lots of pros, but also lots of cons. And I would like to spend some time with you now on these. On the pro sides, it allows you to also test your own ID, to test your product in front of an audience. You have, when you present your IDs in a crowdfunding session, you have lots of people being extremely experts in different fields, and that can really be a nice test for your own IDs. It's also can be used as a first marketing buzz to also get some visibility. It also allows you to start getting into a community levels, to start getting and meet other people also in your own world. And then they can also offer flexible fundings depending, sometimes it's pure equity, or sometimes there are different forms. So it's also you can also find there some flexibility. But as I said, there are also some cons to getting access to crowdfunding. These platforms are extremely competitive, so it's not always easy to shine there. You are next to other projects, and so it's not always easy to make sure that you attract and you are the ones who will get part of these fundings. It's rather expensive. Fees and commissions are not cheap, and so some people forget about that. And during also a successful crowdfunding, do not underestimate the time that it takes. So that might also distract you from your own operation at a time where you have to be really on a daily basis, from early in the morning to late at night, busy with your projects. And again, if it fails, if you do not manage to convince investors in a crowdfunding, that could also create some issues, or at least have some damage on your visibility, on your credibility, because it will be known that you have not been able to raise some funding. So it might be difficult for the next round, or when you are going to meet other investors. And then you also have to disclose some sensitive information, and that's also could be an issue, because it's risk in terms of intellectual property thefts or being copied exists when you have to explain in many details your project, your ideas, to an audience where not everybody is that friendly and has sometimes bad ideas of making a copy-paste of your ideas. And then it also comes with some regulation. Don't think that it's as easy as with families and friends. It also comes with some reportings and so on, so do not underestimate that as well. It's of course much easier, or 10 times easier than an IPO, but do not underestimate that neither. So that was for the startup phase. And then you get into the scale-up phase. Scale-up, you mean that you are growing fast, your product is ready for the markets, has already gained some traction, your marketing is in place, you start seeing your sales are picking up, and you start dreaming. You start dreaming of going abroad. Belgium is a small market. It's a nice one to test your product, but it's very quickly a small one, so very quickly you have to think going abroad. And the challenges are now not only next to your product development, strengthening your product, but of course to also start developing your sales capabilities, but at the same time production capabilities. The worst that can happen to you is that you have demands, but without enough supply. And that means that you have to have staff, you need to reinforce number of functions, and that means that you get to start your production, you get some sales, but also the interesting thing is that, of course, your working needs are growing, but you also start getting some assets which can also be used for financing. And if you look at it from a purely financial standpoint, that means that you have sales, you have most likely, or you start getting into a cash flow positive environment, or EBITDA positive, but most likely you are still in a cash burn situation. But as I said, you start having more options. One of the options is, again, to start asking for more equity. That remains the options. And of course, you start getting, or you start attracting different type of investors. You have either the venture funds, or if you have gone very fast, also the kind of private equity players who might be interested in taking a minority stake in your joint. Then you can also raise debt. But again, there you have different animals in terms of being able to provide you debts. You have, for example, private debt funds or venture debt funds, which offer financing which typically complement the equity raise, but it comes with a cost. It's rather expensive. You should not be surprised to pay north of 10% margin on those loans. And most often they will ask an equity kicker, which means they will want to have an upside also on the equity side. But there, when you're on this stage of scale up and you start having positive cash flows, you can also have access much easily to traditional bank financing. As I said, you start having account receivable. Account receivable can be used for factoring, which is a very nice way to reduce your working capitals, but also making sure that increasing the chance of being paid. You can also work on the whole supplier side, especially in international context. We can provide you with solutions to finance your procurement abroad. And last but not least, you can also use the traditional leasing of your equipment, leasing of your real estate. Again, you start getting cash positive, so these options start getting available. You will ask me what is the best solution there between equity, debt, working capital, asset-based financing. I will not answer this question because the mix is the one which is suited to your situation. There was not a rule of thumb. Every situation is different. So again, that's where we can help you. We can help you finding the right balance, the right mix between equity, debt financing, and asset financing. And then we get the next stage. You are close to becoming, or you have become, or you are close to become a unicorn, and you think about listing. And I'm sure that everybody dreams of that in this room. And it brings, of course, the IPO brings cash. You raise equity, so you raise cash, so it will allows you to fuel your growth, to fuel your additional investment, organic investments, to develop new initiatives, but it also brings many other things. One thing is provides liquidity for your existing investors. Don't forget that your families and friends would like one day to get their money back and with nice returns, ideally. So they don't want to wait for 100 years. So that's also a way to thank them at that time and give them part of what they are invested at the beginning with a nice upside. It's also a very good currency. What do I mean by currency? If you want to grow by buy and build, and you want to go into mergers and acquisitions, you need to have currency, and this listing is your currency. Your share becomes the currency that you can exchange and go and buy additional players and get and be able to grow. And last but not least, it also allows you to reduce your debt. Many companies at the time where they get into IPO have a high leverage, sometimes unsustainable, and post-IPO they can get into a more healthy situation. But an IPO provides many other non-financial advantages. First, you get also credibility and visibility. It's rather obvious. Everybody starts talking about you in the press, at least the few weeks before the IPOs, and ideally, positively, the few weeks after the IPO, because the stocks goes in the right direction. But it's really a nice way to build reputation, and that means a lot for your own clients, for your suppliers, especially if you have strategic suppliers, and also for your staff. It's also a key differentiator when you want to attract top talent. And also, it's increased your transparency, your accountability, which means that it forces you to get into a higher level in terms of governance, which will be beneficial also for your company. But if you already have plans and you all dreams of getting into the IPO, let me also give you some advice. And we'll give you some advice around 3 words. The first one is prepare. Do not underestimate the amount of time that you need to put and the energy that you need to put into the preparation of an IPO. You best assemble a very good team to be able to second you during this period, because I can tell you that you will not be that much present because you will have to meet investors, you will have to meet your advisors and so on, so you better have a very, very good team to help you. And also this very good team is essential because that will be part of what the investor will look like is the quality of your team. So you better have a very good one. You have to prepare also by engaging very early with the advisors, the investment banks, the lawyers, and all these people, because they will help you from the beginning, making sure that you prepare well. Last but not least, be ready for a major change in terms of scrutiny and transparency, which are required by the IPO. You get into a totally different world in terms of what you have to disclose and the kind of reporting that you need to have. You also need to establish a very strong governance, which means, for example, having the right board of directors, having extremely credible people in your board, reputable people in your board of directors. That will also make the difference. You also have to conduct internally a very good due diligence to make sure that you understand what are your risks, what are the danger for you, because these are things that your investor will ask you, what are your major risks, and how do you anticipate those risks? And then make sure that you are okay from a compliance point of view. Do not underestimate that level. That was for the first word, prepare. The second one is story. It's all about having a great story. It's all about having a nice investor story. You have to build it. You have to be able to build a story, an equity story, and you also have to be able to tell it in a way which is extremely convincing. What makes a difference between a very successful IPO and not successful IPO? Very often it boils down to the equity story and the capacity of the management, of the CEO, of the founders to be able to bring this equity story in the nice way. And last but not least, third word is anticipate. What do I mean by that? Do not forget that there is a world at the time of IPO, but there is a world also after your IPO which will be totally different. So you better prepare for the next steps at the same time as you prepare for your IPO. That means preparing for your reportings, preparing for your disclosing the informations, and really starting developing the investor relation side. So allow me to conclude, and I don't know if I still have some time. Our bank is not there just to simply to lend you. We are there to advise you. As I explained, you have different steps, and it's really important for us to guide you, and that's the reason why we also have specific people to help you at this different stage, people who know what they are talking about, who have already helped many companies in the same situation as you are. And we can also help you connect with other people, put yourself in a community of people who you can also learn a lot from. And do not think that banks do not like startups. No, on the contrary, we love you. We love your ideas. We are there to help you. We really want to assist you and to help you. And do not forget also that after or behind every unicorn, there was a legend. It started first with a team, an idea, and most likely the determination of changing the world. And I hope also it started with a visit to our stand, which is a bit further. So if you want to visit us, you are more than welcome. And voila, it's everything I wanted to tell you. Again, if there are some people here with the idea of developing a startups, you are more than welcome to come and see us. We would love to help you, not only because we think we can help you, but we also because this country needs you. Voilà.